It was a dramatic monetary policy today. After a string of 10 status quo policies, the Reserve Bank today cut the cash reserve ratio from 4.5% to 4%, and that allows for more liquidity in the interbank system. With the Reserve Bank selling over $60 billion or thereabouts in the past 2 months to counter the dollar outflow after the Trump election, surplus liquidity in the banking system had contracted by nearly 4 lakh crore rupees. That's in the past 2 months. The Reserve Bank, therefore, the CRR cut. But remember, the Reserve Bank did not cut the repo rate. That is the interest rate. Now, let's listen to what the governor said on the issue of why he did not cut the repo rate.
Prudence, practicality and timing will continue to be the guiding principles for the Reserve Bank's future actions. It is all about dissection of the inflation growth conditions and acting accordingly. Timing of actions is the key.
Okay, I think what he seems to be saying is it's not prudent to cut when the last inflation number that we have, October, is above the 6% CPI mandate, above the mandatory 6% CPI. And it is not practical since rate cuts will not get passed on when banks don't have enough liquidity. Now, just listen to the governor again here.
At present, it is necessary to draw on the flexibility provided by the neutral stance of monetary policy to wait for and monitor the incoming data for confirmation of the decline in inflation.
Okay, so he's going to wait for the decline in inflation, wait for the confirmation. So to me, this plus his forecast that CPI will fall to 4% in the second quarter of FY26, that is July, August, September of 2025, that means perhaps a February rate cut is in order because there could be confirmation of a fall in inflation by then. That's my take, but let me defer to the experts. I have a bunch of the best joining me to parse the policy in terms of the impact on banks, interest rates and the economy. I have with me Mridul Saggar, a past MPC member, former RBI ED, now professor at IIM Kozhikode, B. Prasanna, head of global markets at ICICI Bank, and Sonal Varma, managing director and chief economist, India at Nomura. I think by the end of the show, we will also be getting the SBI chairman, Mr. C.S. Setty, to weigh in on what he's made of the policy. But first, gentlemen, and Sonal, thank you very much for joining me on the show. Prasanna, to you first. This is as expected, you would say, and what is the immediate impact? You think for the moment we should expect yields to fall because there's more liquidity?
Latha, I think the markets had kind of started pricing the CRR cut 3-4 days ago and have been, the bond markets at least have been rallying over the last 3-4 days. So as we went into the policy, I think the pricing of the CRR cut was fully done, and also some kind of a dovish talk by the RBI, kind of acknowledging the slowdown in growth and the need to support growth maybe in the next policy. I think that's what the market was looking at, even though there wouldn't be a expressive change in stance. But what we got instead was, yes, the CRR cut happened, but we did see the governor kind of justifying as to why he didn't cut rather than why he needs to cut maybe later. So I think that is what has led to some kind of a disappointment in, I would say, both the markets. And I think from that perspective, I would say that the bond yields are probably now going to be in a range of 4.7 to 4.8% as we go forward. And like you rightly said, while he's made the case very clear for a possible rate cut in February based on a downgrade in GDP, a further downgrade in GDP and a betterment in inflation, bear in mind that we will also be a prisoner to what happens in the rest of the world with respect to other parameters in January and early February. So while a February rate cut is live, very much live, we can't take it for granted, and the markets have to negotiate in the next 2 months a lot of other developments as well. So that's the reason I would say that we say a range of around 4.7 to 4.8. 6.7 to 6.8.
Okay, got it. Okay, so you're saying this is slightly more hawkish than what the market expected, because you all perhaps were expecting a more explicit hint of the February cut. Mridul, can you sit in judgment of your former employer? You know, the RBI almost lost credibility when the GDP number came in, you know, a good 160 basis points below even their November nowcast. The November nowcast was 6.7 for the GDP, and it comes in at 5.4. So do you think by, unflinchingly lowering the growth forecast across for the next 4 quarters, as well as, raising the inflation forecast, most of that credibility has been restored?
I would go by you. I don't think there was any problem in RBI anticipating a higher growth earlier on. It was a matter of couple of decimals, yes. That's what I had been saying. But when you went into November, it was very clear that the earning growth has disappointed. There is urban slowdown, and somehow the nowcasting didn't pick it up. I mean, the state of the economy still put that chart at 6.7%, which obviously hit the credibility a lot. I think that correction has been made now. There have been significant downgrades in growth, though I personally feel it is probably risks are still on the downside from that projections what we have now. So for instance, if we actually have a 6.7% growth in second half, the full year growth could fall to 6.3%. I'm not saying that is a baseline, but that looks, given that there is an urban slowdown, which is very palpable, the credit growth is not really picking up. So there is a case that basically we might see a monetary policy easing. The central bank rightly hasn't taken that call at this juncture because there is enormous amount of uncertainty, and inflation is just too high at 6.2%. It needs to come down to maybe below 5.2% by December with a seasonal vegetable price correction. Yeah.
That's what they seem to be betting on, because their fourth quarter number is 4.4%. But one person who will agree with you in terms of this growth may not come up to expectation is Sonal. She has been calling for a lower number for some time now. But Sonal, immediately after the policy, we had the finance minister saying that the government is going to spend all the money and keep its bargain in terms of the capex. There seemed to be a resolution out there. So do you think we will get to 6.8 and 7.2 in the 2 quarters, Q3 and Q4, and the Reserve Bank may be right after all?
Well, I hope they are, Latha, but unfortunately, the signals we are picking up doesn't seem to suggest that. I think we need to take a step back and first of all acknowledge what's going on the growth front. What we saw today was actually a dismissal of the slowdown in the second quarter and this anticipation that we will get back to the 7% trajectory, which will sustain over the next 12 months. We're actually not seeing any signals on that. Now, take fiscal policy. Clearly, there's a central government capex and a state government capex. The state side has been slow, and I'm pretty sure the center will accelerate capex. But the 11.1 trillion target that has been set in the budget, we will undershoot that significantly. That is one. Second, the rebound in October because of stronger festive demand. The early indicators actually for November have been very tepid, including when you look at things like passenger vehicle sales. Wholesale is up, but retail is actually not that strong. So dealers are again sitting on inventory, and auto companies will have to probably cut production in the month of December. If nominal GST collections are growing at 8.5%, one can anticipate what the real growth is. So our nowcasting actually for the third quarter is tracking around 6.2%. So 6.8% still looks extremely high. And I think if you look at the combination of, where monetary policy is, where credit conditions are, the net impact, and plus the slowdown in urban nominal income growth, the fading of pent-up demand, the fourth quarter will also be around 6%. So even though the RBI has downgraded the number to 6.6, The tracking estimate is actually closer to 6% for FY25 and around
Oh,
6%. Sorry, around
Okay.
6% for
Okay,
FY25.
Sonal, let me
So there
toss
is a
that.
big downside.
Yeah, let me toss that to Mridul. Mridul, what Sonal is pointing out to our retail numbers, some of the lead indicators. Actually, SUV numbers are good. It is sedan numbers that are bad, even in terms of retail. Luxury things are doing reasonably well. Likewise, of course, two-wheelers have done well. That's not a luxury segment at all. What's your sense? If the government were to keep its word on capex, even then, you think it's difficult to come to a 7% average growth Q3 and Q4? That's what 6.8 and 7.2 mean.
So I already said that there are risks to the downside from the RBI projection. I mean, personally, I feel the growth would be lower, maybe certainly not as low as Sonal seems to be predicting. That would require fresh sort of kind of new developments on the global front to push the growth down. I think the key lies in government increasing its capital expenditure. Now, the capital expenditure year to date, if we take April, October, is 15% down from last year. So that's a big slowdown on the capex front, which can easily be corrected by the fiscal policy. And growth can be supported more from the fiscal side than monetary policy side, given that the inflation is tracking at very high numbers, and it will defy like inflation targeting would really suffer. Inflation expectations can suffer if there are big cuts by the RBI.
Okay, 1 minute. Let me take a quick mid-show, poll from the three of you. Is there a rate cut, repo rate cut in February with the data you have now? Prasanna, yes or no?
Yes.
Okay, Mridul, February.
Yes, I said that last time also in October,
And,
that February
Sonal?
would be a cut. I'm sticking
Sonal,
to that.
yes with an emphasis.
We are behind the curve, Latha.
Okay, fine. So there are three people, all our three experts expect a cut to the repo rate in February. Prasanna, now, what does that mean for yields itself, the yield range you would look at? And more importantly, what does it mean for the rupee? If you are seeing a February cut, are we taking the rupee to 85.5 now?
No, so I think I did speak about the yield impact earlier itself. I'm looking at a range of 6.7 to 6.8 till we, get into the next year. And then we look at the data. For example, today's data, US data is going to be important, and every data which is going to come from now till January is going to be important. On the currency side, Latha, as you very well know, that there has been such a substantial amount of outflows in the last 1 to 2 months. The BOP estimates of various houses, including ours, have gone from a surplus of $40 billion to somewhere in the region of $10 billion or maybe even lower. We need to see some kind of a reversal in, FPI selling in the equity market for us to, revise our view substantially. So give or take all of this, and plus the fact that Trump's policy is being what it is, and it's going to have a good impact on yuan whenever the tariff announcement happens, to whatever extent it happens. I think emerging market currencies are at a knife's edge, and they will have to kind of weaken to compensate for the kind of tariffs that is being imposed on other countries by the US. And when emerging market currencies depreciate, the Indian currency will also have to, kind of follow suit. So while today the lack of a repo rate cut was a little bit of comfort to the rupee market, to the rupee bulls. That's why we saw it marginally appreciating. But the fact of the matter is that we'll have to be alive to this risk. So I do see a depreciating INR, maybe towards 85 by the time Trump takes to office. And after that, depending upon whether the Trump trade globally reverses or whether it continues, will possibly determine whether the INR depreciates further or whether we see a mild pullback on the INR. Okay.
Well, just for FYI, over the last 3 days, FPI inflows have been about 12,000 crores. So, they do also change on a dime. Prasanna, just very quickly, do you know the governor, when I asked him, will you also keep the OMO purchases on the table in terms of, the liquidity shortage that one can very clearly see in fourth quarter? He did not commit. So you think that we should not go with that? In that case, liquidity will tighten again, isn't it? CRR cut can only take you this far.
Yeah, so I think, Latha, you also made the point about the fact that the current CRR cut kind of only compensates for the kind of a loss in liquidity, or partly compensates for the loss in liquidity of the last 2 months, which is correct. And then going forward, there is going to be CIC as well as maybe FPI outflows, we don't know. But CIC is definitely going to be a leakage. So from that perspective, RBI has to be ready with further liquidity options. Now that they have started the path, CRR is not an unending product tool. It has its limitations. So I think the next policy tools that the RBI will have to infuse liquidity will be things like buy-sell swap, how much they can intervene in that, and then open market purchases of bonds. So the thing is, RBI will never commit to it before till the time they actually see the need for it. So we have to see it. They will also possibly use long-term VRRs, but it has a very limited scope. When the core liquidity has been diminishing the way it has diminished, I think the more tenable use of liquidity would be either a CRR cut or a OMO purchase of bonds. So I think OMO is there on the table sometime, but you will not see RBI committing to it before it.
Okay. Thank you very much for that, Prasanna. I'll just quickly get a couple of answers from the economists. Sonal, what is your inflation number for the current year and next in terms of an average? And do you see growth picking up next year?
Latha, on inflation, I think for FY25, we are looking at a number around 4.8, 4.9. Trajectory-wise, of course, October has peaked. We should grind down. And our FY26 projection on average on inflation is around 4.3% in that range. So we are not very concerned, actually, about inflation.
And okay, let me ask Mridul that. Mridul, are we now in a 6.5% growth trajectory?
Roundabout, yes. Yeah. So that should be still okay, given that priority should be inflation at this juncture. And I think as far as the forecasts are concerned, I think the Q1, Q2 of next year looks a little too down. So, I mean, we really need to see a sharp slowdown for that kind of inflation to materialize. But more importantly, let me come to the CRR cut issue, because I think everybody seems to be glued, anchoring to what has happened in the recent parts, and that is the Trump trade on the dollar appreciation. I think that trade has almost played out. So we may not get that much rupee depreciation ahead, and therefore the kind of intervention that is being expected could turn out to be less, and therefore surplus liquidity can come out of the CRR cut.
Okay. It takes a brave man to forecast what Trump has said or will say, and therefore to conclude that the Trump trade is over. You never know what we will get over the weekend or even before the Jan 20th swearing it takes place. But anyway, thank you very much, Prasanna, Mridul and Sonal, for joining me with your take. Clearly, all of them expecting a rate cut in February itself, and inflation perhaps will go closer to the 4% mark. Let's now welcome the country's biggest banker, SBI Chairman C.S. Setty joins us. Mr. Setty, thank you very much. It's really kind of you to find time on what I understand was a very busy day for you. First up, improvement in margins for all banks for sure because of the CRR cut.
Yeah, thanks, Latha, for having me on your show. I'm sorry I couldn't join earlier. I think definitely there would be some marginal impact on the NIMs because this liquidity would definitely help. There's a good amount of liquidity which is made available by the CRR cut. I think there will be some improvement on the margins.
What are you getting in terms of a sense of loan demand, sir? Do you think that growth has genuinely slowed and it will take a little while for the uptick to happen? Can we get it as quickly as this quarter, this month itself, or even next quarter, or do we have to wait?
It all depends on where the credit growth is coming from. I think I still see we have given a guidance of 14 to 16%. we seem to be moving in that direction. It could be that we have had a good, strong pipeline of SME and corporate loan book, so which is getting converted into disbursements now. But my sense is that I think I stated somewhere also is that Q2 seems to be a blip, and definitely Q3 will
Loan demand has picked up.
Loan demand definitely has picked up, and obviously, this October, November months are generally the festival season, marriage season. There are certain products which really get into demand, like for example, auto loans, and these things do well. Home loans, particularly. People want to tie in on the home loans also.
And you're seeing that.
Yes.
Okay. So there are some non-policy related announcements, especially in the form of an AI solution, AI-based solution to identifying mule bank accounts. Anything that excited you about all this? Do you think this is likely to control the problem of frauds and sidestepping of money laundering issues?
So the mule account is definitely a big menace now we are all facing. And I think most of us, the banks, are working with the RBI Innovation Hub in terms of utilizing their AI solution. We have our own AI solutions for identification of mule accounts based on the patterns of transactions, how the accounts are being operated. But I think from a larger system perspective, this initiative is very, very critical, that we all have to work on identification and eliminating this mule account from the system. I think we are working very seriously with RBI Innovation Hub also on this.
Okay. Are you sure that deposits have peaked now, deposit rates, because this extra money is available and you will get, I think, a lion's share of about some 30,000 crore more to give as loans? Can you say that deposit rates will not rise anymore?
So deposit rates, earlier also we have not been fighting the deposit rate war. I think most of the banks have contained the rate war on that. My view is that this is not going to directly impact the deposits or lending, but essentially it eases the liquidity. So which brings down the market borrowing cost and also sends signal in terms of liquidity availability. And RBI always had made an effort, as the governor mentioned, that VRR, that system liquidity is made available. But this is is a great enabler in terms of not maintaining the CRR to the extent of 0.5% is a great relief for the banks.
Okay. I'm just trying to squeeze one more question. I have time. This collateral-free agri loans have been raised to 2 lakh. Does it get fully utilized, sir, or would banks still want collateral? I mean, just for your own safety.
So I think the regulatory mandated limit is 1.6 lakhs, up to which we are not supposed to ask for mortgage. That's what collateral. But banks were never stopped in giving collateral-free loans beyond 1.6 lakhs. But it is also a fact that large number of small and marginal farmers were getting only up to 1.6 lakhs because creating a mortgage would have been difficult for them if the banks wanted. So this limit, in fact, banks have been demanding that this limit has to be raised. I'm glad that RBI has taken this decision. In fact, our recommendation was that if there is a digitalization of land records and we can record our loan details in the records, we can even go up to 3 lakh rupees collateral-free loan. Hopefully, I think we'll still engage with our RBI, but there's a good step in that direction.
Okay, last word, sir, on the policy. What stands out for you?
Obviously, CRR. We really got,
what you wanted.
One thing I didn't hear whether Prasanna mentioned about it. I think this SORR also is something what we've been looking for, because the market moved essentially towards secured borrowing in the market, right? Overnight borrowing. So this is a benchmark to set up with, and maybe some of us probably would look at lending at SORR now as a benchmark.
Oh,
Let's see.
okay. So that was my bad. I didn't ask Prasanna. But thank you very much for filling in and telling us that this is a new instrument at which you all will be lending secured loans. Thank you very
Definitely.
much. Thank you very much, Mr. Setty, for joining me. So that's the policy for you from four of the best voices in the market and in the economy, saying that kudos to the Reserve Bank for cutting the CRR. Repo rate cut expected in February, but some doubts about whether even the 6.8 and 7.2% growth for Q3 and Q4 can really be achieved. Let's wait and see. Thank you very much for joining this special broadcast. Do stay with CNBC TV18. We have lots more lined up for you.
"25 years ago, CNBC TV18 set out to be a part of India's story, your story. For a quarter of a century, we've stood together by your side. Through every peak and every fall,
We see CNBC, the TV, and there's great content in it and great viewership.
navigating the tides with you and becoming your trusted partner and investment ally.
I must say I don't watch business channels, but if I do watch, I watch CNBC.
Turning your dreams into legacies.
And my memories go back to you being a single room studio, to being such a huge facility, and I think from having a few thousand viewers to maybe having millions of viewers.
As we celebrate 25 years of shaping India's economic story, we reimagine the future of India's economy, a future we will continue to build together. 25 years of CNBC TV18. Let's begin the next chapter together.